For the next segment, please welcome the panel on Renewed Opportunities in Private Markets, moderated by Chief Investment Officer for Private Markets at the Hong Kong Monetary Authority, Samson Wong.
So good morning, everyone. I'm Samson Wong. I'm the Chief Investment Officer of the HMA. In this panel, we have several very well-respected private market investors to share with us what's the global and Asia outlook of private equity. Maybe I briefly introduce our panelists today. So on my left, we have Kevin, Partner, Chairman of Asia, and Global Executive Board Member of Partners Group. We have Matt, Partner and Head of Asia Pacific of Apollo Global Management. Gannon, Managing Partner and Head of Asia and the Middle East of TPG. And Donald, Founder and Managing Partner of Celadon Partners. So maybe Matt, I'll start with you. Since the global financial crisis, I think in the last, let's say, 10, 15 years, there were a lot of tailwinds in the private markets. We have very easy monetary policy. We have what I call the peace dividend. And also, obviously, globalization was working pretty well. But now I think things have really changed. And I understand in the current macro environment, I think Apollo is a big believer in investment-grade private credit. Why is that?
Okay, so thanks for having us here. I'd say a couple of things. You noted some of the big tailwinds that have been driving public markets and even all valuations for the last 10, 15 years. Peace dividend, low rates, fiscal stimulus, globalization, money printing at the Fed. A lot of that is unwinding, or at least not going to be as big of a tailwind going forward. You combine that with the entry price of equities today. When you look at the S&P, you look at the S&P today, it's 60 to 70% passive money, which basically means that it's all flow driven. When there's excess liquidity in the world, it's one of the easiest places to absorb excess liquidity. The marginal buyer is an open-ended mutual fund. So when the flows come in, they buy, and when flows go out, they sell. And you have a bit of a bifurcated stock market in and of itself. And so price discovery in the equity markets is almost non-existent. You have almost the same thing in the fixed income market, where it's increasingly passive, and it's 30 to 40% passive. And again, it's a very flow-driven market. You look at spreads today, and you can't really make sense of it, especially in the context of defaults being their fourth highest last year. So you're right. We've been very focused on where is the world going. And investors, I think, are looking at their public portfolios and looking at their alternatives bucket. And their alternatives bucket used to be risky. It used to be just optimized for return. That used to be venture capital, hedge funds, and private equity. But starting in 2008, you had really debanking taking hold in the US and a little bit in Europe, a lot less so here in Asia. And so banks started divesting a lot of the businesses that we're in. So you had private credit, then you had operationally intense businesses, then you had large cap lending, and next you're going to have ABS. And so when you marry the two, you now have investors looking for an alternative to the public markets. They need something where they can still generate alpha, where they can look at the fundamentals and not just be subject to flows. You can be the single best investor in the public markets, and you lose 92% of the time because you're getting the flows wrong. And so investors are looking in their portfolio, how do we use alternatives as a way to get alpha and fundamental investing? Again, that used to be risky, but given that the banks have now pushed a lot of this safe product into the investment marketplace, it's now no longer the case that public is safe and private is risky. You now have safe private assets, safe public assets, risky private assets, risky public assets. And so you're right, we've really combined those two trends to offer investors a bit more of a menu of alternatives so that they can dial up and down the risk. And the only question is then, what liquidity profile do you need in your portfolio?
Thanks, Matt. So I just want to follow up on that because, everyone talk about private credit these days. And I'm curious, for someone that has a big private equity portfolio, should they consider private credit? Is private credit for everyone?
Well, it depends on what you're ultimately looking for as an investor. But if you're a private equity manager, I think 80% of buyouts in the U.S. now are financed by private credit because the banks don't really know, the banks aren't writing large-scale commitments. If you're a private equity manager, should you get into private credit? That's a little less obvious. Because if you look at the private credit as defined in the headlines, that's risk-taking. It's LBO financing. It's mid-market financing from 0 to 6 times. And it really takes a credit mindset, a credit ecosystem. It's not really, and it's much more of a flow business. It's not really an equity business. And then if you go to the broader definition of private credit, which is everything on a bank balance sheet that's now coming off, you need the ballast of investment-grade capital to do those products and invest in those products well. And so you think about the big pools of investment-grade capital across the world, it's banks and insurance companies. And so if you don't have access to that investment-grade funding, it's difficult for you to build a long-term sustainable business in the safer private credit end of the world.
Thanks. So Gannon, I'll switch to you now. I think ever since the Fed kind of raised interest rate pretty quickly from 0 to 5%, the private market has kind of really changed in the sense that, let's say, 2023, deployment was generally very slow, distribution was very slow. So in the current environment, what's interesting to you right now when it comes to investment? Are you able to deploy capital?
Yeah, so I'd say I think the most attractive space that we've seen are markets that have the ability to generate public to private opportunities. Public and truly public stocks adjust themselves very quickly. The public fund managers are able to kind of start the year and start from a baseline and make a decision around selling a company with, sometimes less emotion than a founder might. And so, we've found quite a bit of opportunities in that. The Australian market is a great example of a market that has a widely owned public mutual fund and other savings funds investments. So that's been an interesting space. We've just traditionally, as a firm, loved certain sectors like healthcare and in Asia, consumer, that we continue to kind of lean into. There's probably some stuff on the discretionary consumer that we are kind of sitting on the edges a little bit, unless it's the risk reward is good enough. But I would also say I think this is a time where quality is probably going to trump quantity. And so we're probably leaning into larger opportunities and taking fewer companies into the funds than we may have historically.
Thanks. So if I can ask you a little bit of academic questions that I think bother a lot of LPs. As I've mentioned, we are in a different environment now. High interest rate perhaps is high for longer. And there's a lot of debate about the longer term outlook of private equity return, right? I think we had a very good run in the last 10, 15 years. The return was extremely good in private equity. What's your take on that? What's the medium to long-term outlook on private equity?
There's no doubt that I think, broadly speaking, all of us have benefited from a certain amount of low interest rate environment as an opportunity for excess returns. The reality is that each firm's going to be very different in terms of where it's made its money. And I think some sectors lend themselves to more leverage than others. Some markets may lend themselves to more leverage than others. If I look back at a 25-year investment history in a market like India, for example, we've not been able to use leverage, right? So those returns have really been generated from working through growing businesses, watching your currency depreciate, watching a certain amount of inflation, not as high as perhaps we've seen in the post-COVID stimulus in the Northern Hemisphere, but nevertheless, a little more inflation that you've seen than other markets. And that's been able to generate a certain return. And I think across the board today, amongst private equity portfolios, the Indian portfolios all seem to be looking pretty good and pretty healthy, and they're generating that return. There are going to be other markets where leverage has been an important consideration, where you now have to reset and work for your alpha. But listen, I think I wouldn't be betting against private equity. There are enough tools in the toolkit to be able to produce the changes that need to be done. And I think the industry will adjust itself to be able to push and outperform returns to the baseline that's now been reset.
Thank you. So Kevin, I'll come to you now. So Partners Group, I understand you guys have many different products, investment strategy, right? Primary, secondary funds, co-investments, direct PE, real asset, etc. So we'd like to hear what most interesting to you among all the different strategy. And I don't know what's your answer, but I'd love to hear your thoughts about secondary as well, because in the last 2 years, we have heard so much about LPs rebalancing their portfolio.
Sure, yeah. So Partners Group, as Samson, as you mentioned, we manage about $150 billion all in private markets, right? And about 70% of our new capital deployment is our direct control transactions. Roughly 20% is in the secondary space you mentioned, and 10% is the traditional fund of funds business, right? So yes, we play the sort of the full piano, so to speak, of private markets. Therefore, we sort of see how things, the whole market dynamics, etc., right? A couple of things are, I think, of particular interest. One is infrastructure, right? So this is sort of emerging compared to the traditional private equity or private credit. Infrastructure is a fast emerging, newer asset class. I think everybody started about 12 to 15 years ago in a way, right? Unlike private equity, has been there forever. And also infrastructure is also interesting. One of the points you and Matt talked about, you asked Matt about the private credit, right? So I see infrastructure, depending on whether you're on the core side or whether you're on the value add side or in the middle of the core plus side, you actually see the more private equity-like infrastructure and the more credit-like infrastructure, right? So that's another way to give LPs an exposure depending on which spectrum on the equity and credit side. So infrastructure is interesting. And private credit, Matt already covered, right? So we also have a private credit practice focused on sponsored transactions with private equity sponsors we know, and that has been a fairly good business for us. We continue to believe in global buyouts, and in spite of some of the questions you and Garland already talked about, because fundamentally in the private equity buyout space, you still have that active control ownership, which is always a premium, right? Compared to if you're a passive, small owner of a public stock, there's nothing you can do other than hoping the management will do the right thing, right? We own those assets. We work very closely with our management. So that is just by definition there as an advantage. And also today, I think a lot of the inefficiencies we talk about, whether it's from deglobalization, geopolitical tensions, in fact, I think when you think about the inefficiencies, it just gives the most sophisticated players like us more ways to use these tools and toolbox that Ghana mentioned to extract return out of the assets. So definitely buyout. Finally, you asked about secondaries. Secondaries, we see this whole space growing, right? And for the very simple reason, the 30 seconds on that is that the LP-led secondaries is essentially driven by how much primary fund of funds sort of commitment 7-10 years ago. That has been growing by 13-14% in the last 20 years. So mathematically, there's a bigger deal flow for secondary LP stakes on the market. It's also number one. Number two, it's driven by the realization, right? We all know the realization in private equity has been much slower. So therefore, there are more LPs who wanted to realize their return. So it's a bigger base, a bigger portion of that base. And finally, it's a rising cost of capital, right? The interest is going up. If you're LP sitting here, 10 years ago when you got into a fund, that's your cost of capital. Today you are here, so you have more reason to sell, right? So we see much bigger deal flows on the secondary side, which is why we just launched our number 8 private equity secondary strategy. It's going to be a $10-12 billion strategy, bigger than the last fund. We see probably 2 or 3 times of deal flows on the secondary side.
I see. Thanks. Kevin, I'll stay with you for another questions. We'd love to hear your thoughts on the private equity in China as well. I understand a few of the global GPs have attended the China Development Forum, and you also went there. So what have you learned from our leaders in China?
Okay. Okay, that's a loaded question, a lot of angles. Let me maybe share two or three thoughts. Yeah. One is, I guess everybody these days talk about Chinese economy. Where is it heading? Is it as depressed as the guy sitting next to you think, right? So I did collect a bunch of data points over the last 3 days that in Beijing at the China Development Forum. The way I see it, again, I mean, running the risk of being overly simplistic, is that all the problems we see today, the economic problem China has, there are probably half a dozen bigger ones. Everybody heard of them many times now. I don't have to repeat it. Most of the problems are old problems, right? The lack of domestic consumption to drive economy. That has been the problem that Beijing has identified for at least 15 years, right? There are some older problems which become bigger today, right? Real estate, export being reduced. There are no new problems, right? It's an older problem getting bigger. So the urgency I feel in Beijing over the last 3 days from the policy perspective does not necessarily come from the fact that they think, oh, we never realized there would be a real estate problem. It comes from the fact that there's a confluence of those factors. They're all happening at the same time, right? If you have the real estate market no longer driving a big part of GDP, and which is related to the local government financing model for the past 30 years. And some local governments, not all of them, are really having fiscal problems to the extent that they have to rely on their SOEs, right? So you have those problems coming together. So that's sort of the backdrop for private equity investor to think about, right? So there's a confluence of negative factors the country is working through. I'm optimistic because I think Beijing have the toolbox. The other thing is that you have to look at China, think about, is the problem all short term? Are these like 2008, 2009 subprime crisis situation, or is this a set of longer term challenges that it's better for the country to sort them out with longer term solution? I'm of the second camp, right? I'm not in the first camp to say, oh, you should do another 4 trillion stimulus. I think that's the right response in 2008, 2009 for the Chinese government. It's not the right response to today. My final point, going back to your question on the private equity, is that if you think the government understands these problems, long-term problems, the fact that they have not rushed into providing stimulus or short-term fixes, that means they want to solve those longer problems in a more robust way. That for us as private equity investor, it's a good thing, right? So for me, for example, we have, Partners Group has a very healthy private equity portfolio in China, right? So we have been very selective. We invested about 1.7 billion of capital over the last 10 years within direct deals and secondaries. And if you look at our direct portfolio, it's marked today at 2.4 times, right? So we are not subject to those up and downs. And so if you know what you do, if you are selective, and I think that's the other good thing of private equity, is that we have the luxury to be selective. Even when you grow to the size of a few of us, you can still be very, very selective. You don't have to follow the flow and be the victim of the flow.
Thanks, Kevin. So Donald, I'll come to you now. Last time when we spoke, you shared with me a lot of the opportunities you're seeing in Asia. Can you share those with your audience, and what's the investment focus right now for your firm?
Sure. I guess to start, I'm a little bit different, much smaller than most of the other panelists on the stage today. We're a single strategy firm. We're a mid-market PE firm. We're Asia focused, and we try to be nimble. We try to focus on kind of real businesses that we can invest into, mostly in industries that are in transition. And for some reason, maybe changes in technology, potentially new innovative business models, they can kind of transform themselves. That's really our bread and butter. So we're playing in a much smaller, but I think just as interesting, if not more interesting, space. I would say as an Asia-focused mid-market investor today, this is by far the most interesting time to be investing, which I think is somewhat surprising when I talk to a number of investors. Asia obviously is the workshop of the world. It has the most consumers. By definition, then, many of the mega trends that are happening in the world today will impact Asia. You think about all the changes that's happened in the world in the last 5 years. It's kind of mind-blowing, right? There's rates, there's macro, there's geopolitics, but also on the technology side. What's happening with development of AI, right, and the tools and the infrastructure needed to support that. All that has a nexus with Asia. Asian businesses that are in the mid-market have to figure out how to adapt themselves to kind of this new world. They have to be more global. They have to make changes in how they operate. And so that's kind of what we focus on. There are a lot of very interesting kind of incumbent, more traditional businesses that historically, for various reasons, have been margin constrained, have done business a certain way. And all these assumptions that go into, let's say, the supply chain are up in the air. They can be reconsidered. They can be redesigned. And I think that is an opportunity, right, where an investor like us can try and add value and provide strategic direction. The skill set that's required obviously is different than before. Like others on the stage, we have to retool ourselves. It's not just sufficient to be the most local with the most relationships locally. Right? It's about having kind of a much broader global purview, and we've tried to really embrace that. At the same time, the opportunity set is massive if you can do this well. Right? Just look at the value dislocations in the world today. Everybody knows these statistics. Maybe a third of all listed companies in Japan are trading below book value. There's plenty of ADRs listed in the U.S. with Asian companies where they trade below cash, negative enterprise value. This is kind of a sign of concern and worries, right? That problems that need to be fixed. But at the same time, there's also incredible kind of euphoric kind of valuations as well, if you look at some of the hotter topics of the day. So our view is don't chase what's hot, but try to find what is derivative and still benefits. 1 degree removed, 2 degrees removed, 3 degrees removed. And in the supply chain, there's plenty of very, very interesting opportunities where you can benefit from some of these trends, invest only in the single-digit kind of entry multiple level, as long as you're willing to kind of roll up your sleeves and get very involved operationally and help them kind of chart the new path. So, lots of examples of this. Consumer, right? A lot of consumer brands have reinvented themselves to retail much more efficiently. If you sell direct to consumers, limited edition products that have 100% sell-through that people will stand in line to buy, that's great. The supply chain doesn't really enable that very easily in Asia today. It's all about massive volumes at the lowest cost. That change is actually very relevant to sustainability as well, a lot less waste, a lot less discounted and discarded product. You look at healthcare, huge kind of innovations coming with CRISPR, mRNA, CAR-T, CAR-NK, you name it, synthetic biology. Again, that requires a very different supply chain to support and enable. A lot of that supply chain is in Asia that's has real changes that are coming. And we want to position ourselves to take advantage of that. You look at kind of AI and services. Services has basically historically been constrained by labor, right? Margins cannot be excessive because of labor. All of a sudden you have a tool that has the promise of revamping productivity enormously. What are the companies that might benefit? What are the companies that need help and benefit? I think a lot of them are within kind of that mid-market universe. And so for us at least, we think it's the most interesting time to be investing today, despite some of the headwinds, some of the challenges, and some of the issues that people are facing. The more problems we can solve, and that's how we create and capture value.
Thanks, Donald. Matt, you came to Asia, I think a few years ago, with the ambition to develop a private credit business for Apollo in this part of the world. But as we all know, Asia is dominated by the banks. I may be wrong, but I'm told 85% of the financing is done by banks in Asia, or even more. So are you taking on the banks in Asia and trying to steal business from them? And what do you think private credit will look like in Asia in next 5-10 years?
Yeah, good question. I like to joke that, I didn't anticipate when I came out to Asia that the Fed would raise rates 500 basis points, which has really tweaked the real val between the capital flowing to the U.S. versus capital flowing to Asia. Look, your points are all right, but I'd recharacterize a little bit what we do and what we're building. A lot of the Asian markets have amazing equity ecosystem. I mean, it's really developed over the last 10 to 15 years. You have awesome local managers. You have big global managers that are doing great business in equity across Asia. You also have banks that supply most of the credit. Our job is to provide that which neither of those two pools provide. So either in between credit and equity, which we call hybrid, or adjacent to the banks. And so let's give examples of both. So for hybrid, that's really the way we like to play our equity thesis or express our equity bets, because at our core, we're still a purchase price matters investor. We're still a value investor. Asia historically has been the land of growth. And so other than Japan right now, which there's other reasons why we're doing PE, private equity there successfully. But for us, it's a way to get downside protection and still align ourselves with an entrepreneur or a sponsor or a corporate on the equity upside. And from our perspective, it's actually much better from a selection bias perspective, because a lot of those companies have two choices. They can either go raise debt from the opportunistic credit funds at 13, 14, 15%, or they can take on private equity. But a lot of times they don't want to sell control. And a lot of times entrepreneurs believe their businesses are going like this, and we all believe their businesses will go like that. And so hybrid is a very natural product for us to come in as senior equity, get a guaranteed return of 6, 7, 8%, and then anything above an 18, 19%, really start to share that back with the equity. So that business is going great because the proposition of having mid-teens cost of capital without having to sell control, without issuing dilutive equity, and tapping into the $100 billion private equity business that we have globally is a pretty good, attractive prospect for a lot of entrepreneurs and companies that are trying to grow. On the private credit side, look, the challenge with private credit is that it has to be market by market. And so you need to kind of delve down and have a thesis on the big areas where the banks don't play. So what are the big areas that banks don't play? There's three that are kind of consistent across Asia. ABS, which we do, development lending, which we do, and very large investment grade lending that isn't easily done on the banks, on the bank balance sheets or syndicated in the markets. I'll just give like the most brain dead example of that. Think of an investment grade company, A-rated, that has a big CapEx program. And they need that, and that CapEx program is going to take, it's to support a 7-year business plan. So they want to match the duration of the cash flows with the debt. And because they have a big CapEx plan, they need 1 year of PIK. Okay, now the banks can't do it, now the syndicated markets can't do it, and it's phenomenal risk, but companies are willing to pay an extra 100, 200, 300 basis points for that flexibility. So that's why I said it's either filling in the gap between the equity and the banks, or it's doing that which is adjacent to the banks. And the easy, obvious asset classes are development lending and ABS. I think the one that's harder to go get and requires real structuring expertise, scale of capital, and the desire to want to allocate some of your fixed income bucket to privates is what we call this high-grade alpha investment grade lending, but it's on a very bespoke basis where the banks no longer do it and the syndicated markets don't want to do it.
Thanks, Matt. Again, I'll come to you now. Let's talk a little bit about sustainability. I think TPG is one of the first mover in the impact investing and climate investing. And it's great to have Jim here to join us yesterday as well. Can you just share with us a little bit what is like the journey in terms of how TPG developed its investment in climate? And obviously with your role in Asia, what kind of climate opportunities do you see in Asia?
So I think if you go back to when we started in impact investing, it was about 8 years ago. We started the Rise platform that we branded separately to TPG, as we wanted it to be encompassing of what was the start of this journey with many other firms now also participating in it. And it was a diversified impact platform, of which climate was a portion of it. As we sort of progressed into past Fund 1, Fund 2, and into Fund 3, we found a significant amount of our investment opportunities that were pretty capital intensive, was in the climate segment, and we felt that was a time to actually raise a separate dedicated climate fund, which we did, just as we were heading into COVID. The journey's been a really exciting one. Our co-founder of our firm, Jim Coulter, decided to go and lead that effort himself. And for those who were here yesterday in Hong Kong, you'd have heard him speak very passionately about it. And it's obviously a very exciting thing for us as a firm and for him personally as well. In Asia, it's a really interesting time right now because I think if you step back and look at what's happening with the geopolitics around the world, is everyone is looking for some degree of self-sustainability. You're also seeing an element, and Donald talked about this, of redrawing supply chains and where you're headed around trying to be self-sufficient, right? And COVID kind of brought that to roost around survival in some parts to it. And in a lot of that, it's about energy, right? And how you can sustain yourself with that. We've had significant investment by China and a number of other countries into storage for that. But really, I think the ultimate opportunity here for Asia is to use the various and varied natural resources that we have to generate those alternative sources of energy. The technology curve has been significant in this. There have been very exciting companies that are refining, for example, the efficiency that you can get from solar panels, from wind. And so we think the opportunity set is immense. We think China, India, the large population economies of Asia, Indonesia, are all very focused on this, and it's the one thing that I think everyone can agree that they all want to do. I also think the evolution of the electric vehicle and batteries, everyone's producing their own batteries, right? So nobody's leaving it to global central production right now. So we think Asia will generate quite a significant amount of opportunities. We're embarking on our own sort of investment targeted sleeve called the Global South to focus around investing in Asia, in Africa, the Middle East, as we see opportunities that are very specific, to which we see a lot of partners from these regions also wanting to participate in that.
Thank you. So Kevin, I know you also chair the impact committee of your sustainability fund, PG Life. Is there anything you want to add or share with us?
Sure. Maybe from our side, so Partners Group, right? We started the thinking process about sustainability and impact almost 8 years ago, as TPG was launching their first Rise platform. I think that was the inspiration to the market. I thank TPG for that. So the interesting thing is that when we were doing the market sort of research at that point, we said, okay, if we want to offer our LP impact offering that's of scale, who else are out there, right? 6-7 years ago, there were only 2 or 3 players, right? TPG, Bain Capital, and so we launched something called PG Life, $500 million product 6 years ago. We were one of the top 3 or 4, right? And then, and I chaired the impact committee for the first 3 years. And then a couple of years ago, my team came to me. He says, oh, we want to give you an update about this space. Do you want to hear the good news or the bad news? I said, tell me the good news first. I'm an optimist. They said, oh, they just have a ranking of size of the impact offering, and we're still on the top list. I said, that's great. I said, what's the bad news? They said, we're now the number 20 in the top 20, right? So I think that space has grown tremendously, which is a good thing, right? Which means a lot of GPs are offering that now. We're now launching our second PG Life, which is a $1 billion vehicle. And I continue to believe the key 2 ingredients for that space, in order for the LPs to be interested in this, one is you have to offer them dual return, right? You cannot go to an LP to say, this is the impact, therefore you're going to sacrifice 300 basis points. That just doesn't work for our pension funds clients. It doesn't work for our sovereign wealth clients. And second is scale, right? I think many of our LPs want impact, but they also want to move the needle. They want to be able to write larger checks. They want larger assets. And so that complements the other smaller players. So we continue to operate under those two principles for PG Life too.
Thank you. Donna, I just want to maybe ride on your earlier comment. I think your firm has been a big advocate of the adoption of technology in your investments. Can you just share a little bit more, and do you see a lot of low-hanging fruit in Asia right now when you look at your portfolio companies?
Sure. So yes, absolutely, lots of low-hanging fruit. But if I could just add to one comment that Gannon made, power is super interesting, right? We were looking to kind of the AI supply chain and spend some time with a server manufacturer. Basically, they use labor to assemble servers. And shockingly, the constraint on their business wasn't just chips, it was actually power. Turns out that when you make something, you have to test it. If you have to test it, you have to plug it in. All of a sudden, there's a huge demand for power that never was necessary. And so there's actually very interesting things happening on that front. If you look at kind of data centers, right, $1 trillion plus CapEx spend, it doesn't all go into chips. There's all kinds of other things that go into that. And maybe this focus on renewables requires a very different way of imagining kind of power grids and how these things are supplied. But back to kind of technology and investing, we kind of have a view that there are a lot of very traditional industries out there that people kind of just overlook. They don't like it because historically it's been margin constrained, it's been all labor, so they trade at low single, mid, EBITDA multiples. But with kind of the changes in the world, a lot more is possible. We spend a lot of time, let's say, in footwear, where if you are a Nike, you're a wholesale business because you don't want to own inventory. You get too many sizes, and if you don't sell it, it's very costly. You have to discount it and write it off. It turns out if you have hot products, which of course they do, and you can sell it direct, 50% of the retail price is potentially pure margin. If somebody will stand in line to buy it, there is no inventory, it's 100% sell-through, that's great. The current supply chain actually is not designed for that, right? It's designed around millions and millions and tens of millions of units at the lowest price, and once you have that, then you have to sell it through wholesale. Now, what if you could kind of change seasonal order cycles to something that is monthly, quarterly, on demand, very small batches, limited edition products. They could be created very cheaply, still, and then use that as a new retailing model. Right? Then you capture 50%, more of the retail price and margin. It's transformative. It's multiples of what each product is worth. The problem is the existing supply chain can't support that. It's all about labor. You can't train 1 million people to make something new very quickly. So you can solve that with technology. If you use automation, if you use 3D printing, knitting technology, other approaches to that, if you have new design processes where you can kind of really shorten the ability to, the time it takes to kind of create new products. If you can apply, and this is just starting to scratch the surface, if you can apply generative AI tools to not only kind of create pictures of designs, but actually convert those into 3-dimensional models to create them into programs that a knitting machine, a piece of equipment can actually use, all of a sudden, that whole dynamic changes. You can actually be very nimble, create very small batches, and you don't sell as many units, but you actually capture much more margin. As a result, that becomes a high margin business. We think the way to do that is not to bet on startups. In all cases, in some cases you want to be Uber, you never want to be the taxi company, but in many cases in the supply chain, having a large base of revenue that you can start with, having customer relationships that you can kind of mold, makes a very big difference. And it's the operating leverage, right, where you go from a 3% net margin manufacturing business, OEM, to something that enables your customer to make a lot more money, that becomes multiples of the margin. That's really where the returns might come from. And I'll give you an example when it touches on sustainability. Right, there's a lot of focus on sustainable yarns. So having zero carbon or having recycled cotton, recycled polyester, things like that. Turns out those businesses, those startups, have great technology, but they have a go-to-market problem, right? Which is, at the end of the day, the brands that use materials want to see products. They can see a spec sheet, hey, everything's great, it's very green, but until they know it can be made into a product that has the right performance characteristics, that is really what they're looking for, they don't have to make kind of sacrifice on kind of their end product, it's very hard to make that sale. Well, it turns out if you are a large supplier, tier 1 to some of the big customers and the big brands, you have a perfect opportunity to kind of sell into that, right? So I think there's a lot to dig into in Asia because it is the workshop of the world. So much is changing, and technology is going to make a lot more possible. So just a couple of quick examples that come to mind.
Thanks, Donald. Gannon, Donald was looking at you when he said you work for a big private equity firm. So the way I see it, the big firms are getting bigger. And TPG, I think you guys bought the secondary business and also a big credit business in the past 2 years. Can you just share with us, do you think this is a longer term trend in consolidation in the PE sector? And is it a good or a bad thing?
Wow, that's a loaded question there. Look, I think at the end of the day, there is still a lot of white space for private capital to actually grow. And when you think about the various tools that we have in private capital, whether that's private credit, whether it's private equity, infrastructure, we have a lot of the economy today that we're responsible of employing. We have a real opportunity to fund exciting businesses that Donald's been talking about. We have an ability to be nimble and use that toolkit. So from my perspective, you've had a long period of time for asset allocators on the public side to grow, and they're multiples the size of the large alternatives or private capital firms. So I think that journey is still there. Speaking for ourselves, I think we really want to try and grow and expand, but still try and maintain the culture that we've kind of developed, which is a little bit of informality, a little bit of a small firm kind of culture, but expanding what we can do for our clients ultimately, and it's that mix, that balance that we're trying to achieve ourselves. So we're not aspiring to be the largest firm, but really to try and have across the board the products that we can build long-term relationships with clients.
Thank you. So I see the clock is ticking, but I have a few more questions actually. But in the interest of time, I have one last question for each of you. If you can just spend 30 seconds answering. What is your prediction, anything, for private equity or private credit in the next 5-10 years? Maybe I start with you first, Kevin.
I think a number of things we could guess, but if you have to ask me, I'll talk about something very specific in Asia. I think the RMB onshore opportunities in China, I think will grow tremendously. I think all of us probably more play on the US dollar side of China. The numbers I see, the RMB fundraising is 7-8 times bigger than the US dollar fundraising. It has grown at 24%, over 6% of US dollar. And with all these confluence of factors, I think there will be a resettling of the RMB space that would give more opportunities for players like us, which in the past may be hesitant about, do we really go onshore or do we not? And so that would be one specific sort of areas I would look for. It hasn't reached to the level of making a prediction, but that's something I'm looking at. Yeah.
Right, thanks. Matt?
Yeah, look, all of us are talking about private credit. Private credit means sponsor lending to most of us. I think 5 years from now, if you look at that market size, it's $1.5 trillion. When you look at that which is coming off bank balance sheets in the next 5 to 10 years, it's 20 trillion plus. I think we're all going to be talking about ABS. I think we're all going to have an ABS allocation. I think you'll have an ABS business. I think you'll have an ABS business. And I think private credit will be ABS in 5 years.
Thanks. Ken?
I think an interesting trend is going to be the importance of the region of Asia and the Middle East as a source of capital. And I think increasingly capital allocators like yourself, Samson, are probably going to be as focused about the developments in the local economies and what actually happens in terms of reinvesting in the local markets besides just looking for returns.
Thanks. Donald, you have the last word.
Great. I think, well, number one, I don't think I'll have an ABS business. I think
You'll be surprised.
the dichotomy of investing is that when capital is flush, everything's expensive. When capital is scarce, everything becomes much cheaper, more interesting. So I think over the next 5 or 10 years, I hope there'll be an explosion of more specialized, smaller firms that are competing in a playing field that is starved of capital and therefore will generate great returns. And we hope to be one of those. So,
thanks, Donald. So with that, could we give them a round of applause, please? Thank you.